Is it better to invest in stocks or real estate? Now, this is a question that puzzles a lot of people, but by the end of this video, you'll have all the information you need to decide how to invest based on your goals and financial situation. Stocks or real estate? Which asset class do you think has the potential to yield higher returns? Which one do you think carries more risk? If the answer seems obvious, you may be jumping the gun. I've been a money manager and a stockbroker for 15 years, sold that company in 2006, and for the last 20 plus years have been an active real estate investor. So your return on investment should not be the only thing that you consider when investing. Today, I'm going to be discussing diversification, taxes, and a few other factors that you should be thinking about before you go all in. By the end of this video, you'll know how to make an informed decision based on your investing goals. So let's dive in together. First, let's dive in and talk about risk and return. We want to take a look at and compare those profiles for stocks and real estate. So, stocks typically have a return profile, if you look at the long-term average, of about 10 to 12%. Used to be a little bit higher. Now, most indices are pegging it at about a 10% number. Now, what that also means is in order to obtain that return, you have to be willing to take on what they call volatility, meaning the market goes up and down. Last year, 2022, the market's down roughly 19%, depending on what segment. It's down maybe 25 to 30%, depending on your concentration in certain areas. But as an average in the S&P 500, down about 19%. So you've got to be willing to stomach or tolerate some of those swings in the market in order to get that return. Real estate investing, depending on the type of real estate, whether it's single family homes, multifamily homes, or other commercial, has a range of anywhere from 8 to 12 to 15 to 16% return. So now you still get a high return opportunity, but yet then you also have the benefit or stability that comes with the fixed asset of real estate. So you can decrease that volatility while still increasing your return. Let's next talk about diversification. So realistically, it's not advisable to be 100% all in on just one thing or the other. Now, again, I remember as a stockbroker, many people were like, oh, I'm all stocks. And yeah, they're all stocks till it's all bad. And then now they don't want to be all stocks. So the value and benefit of diversification is even within stock investing, you can diversify your portfolio, but you also want to invest outside of the stock market in what's called non-correlated assets. And so real estate, the return there is not correlated to what's going on in the stock market. That diversification can actually provide a benefit to you from one, providing greater stability for your portfolio, and then it also can provide greater returns for you over time. So diversification is a key element to your investing strategy. If you're enjoying this video, make sure give it a like, subscribe to my channel, and comment down below what you'd like to learn next. Next, let's talk about liquidity. Stocks are a more liquid, actively availably traded market compared to real estate. Now, stocks, for example, if you own shares of stocks in the S&P or typically publicly traded on the NASDAQ or one of the exchanges, you could sell it same day and the market clears, you have your money that night the next morning. Real estate is a little bit different. There's more transactional nature to it, so it takes longer to sell a property, so you have a bit more of a time frame to it. Now, that being said, as a stockbroker and a money manager for 15 years, I would advise clients, though, that you need to maintain a liquidity apart from either of those investments. You want to have typically 6 months to maybe a year's worth of liquidity so that in the event that there's challenges in the market, again, like last year, the stock market's down 19%. A lot of times what people do is the market's down, I don't want to be down anymore, so I pull the money out and they've locked in their loss. So again, not the best move. Or the market's down and so I need money, so now I've got to pull money out for my needs, and then they're locking in a loss. So again, the better method for liquidity is to have that reserve set aside apart from your stock market or apart from the real estate investments so that you can have that access that you need. Okay, next let's talk about passive versus active. In both categories, you have the availability of both to choose to whether to be passive or active. So in the stock arena, you can be a passive participant, meaning that you've allowed for a broker or a money manager to choose your stock selections, choose the portfolio allocations, and then manage that for you. Or you can actually go in, set up your own brokerage account. There's multiple online forums, and you can do that now yourself. The other category within real estate, again, active versus passive. Active, you can go out and purchase a rental home or a duplex. There's challenges that come with that because then you got to actively manage those affairs with tenants, toilets, and some of the headaches that go with that. And then on the passive front, you also have the ability to be passive by investing in larger syndications of properties like we do, a multifamily. It's done for you, and so it really is that you have the opportunity to choose both ways in both asset categories. Next, let's look at tax benefit and deduction. So realistically, when you look at and compare the two, real estate has a tremendous amount of benefits to it because of the fact you're owning hard assets. The tax structure, government regulations give you the benefit of that ownership through depreciation, which is a significant offset against income. And then when you look at stocks, a lot of times you're not as tax favored with that. Now, again, if you hold them long-term, past 12 months, you can get long-term capital gains treatment, and that will reduce the tax down to a capital gains treatment versus your personal income. Now, if you're investing or selling those stocks in a more short-term basis, that then comes back in and is treated in your more normal income tax rate. So again, it's important to look at both, and it's also important to understand that you can achieve certain tax-adjusted returns that may be higher with less risk using the real estate. So again, like I shared with you already, I've been a stockbroker and a money manager 15 years, an active real estate investor for 20 plus years. So my personal take on it, it was really when I saw in 1999, the market was going down, the tech crash, Y2K was all happening, and I owned this incredible duplex that's just basically printing off money every month. And it was at that moment I looked, you couldn't really escape some of the downside that was going on during that time in the market, but the real estate was just completely stable. The value was actually increasing, and my rents were coming in like clockwork. And that's when I began my real investigation, if you will, into real estate. And really what I found is that the beta adjusted returns, meaning the risk adjusted return, was a greater result in the real estate. And so for me, I made the active decision to sell my money management practice and move all in with real estate. And that's been 20 years ago. And my life would not be the same without it. I have a free gift for you in the description of this video. 2023 has been a rough year for the markets, and people are wondering how they can protect their portfolios and thrive during the economic volatility. I recently made a free training to show you how to recession-proof your portfolio with multifamily investing. It's completely free, and you can view it by clicking the link in the description. That's all I have for you today, folks. I hope you were able to learn a lot today, and I'll see you in the next video.